Fair value gap, one of the most powerful concepts in trading. This exact strategy has led me to many profitable trades in my career. But the problem is, many traders actually use it incorrectly, causing them to lose money from it. The most confusing part about trading the fair value gap is figuring out which ones are most likely to work. But here's the truth. Not all fair value gaps are equal. Some have a much higher chance of being profitable than others. In this video, I'll reveal the secret hacks to help you spot which fair value gaps have the highest chance of success. And as a bonus, I'll also reveal the top 3 trading strategies using the fair value gaps that I use to land consistent profits. First, what is a fair value gap? A fair value gap is a formation on a chart that involves price moving sharply towards one direction, forming a gap on the candlestick. Often the price is then drawn back to the gap like a magnet, as it attempts to retest or fill the gap. Traders can then look to enter a position at the gap, aiming to profit as price tends to bounce off after retesting it. To plot a fair value gap, you first need to identify a 3-candle sequence. Then, look for a large candle between 2 smaller candles, where the high of the first candle and the low of the third candle do not overlap with the middle candle. The gap between the high of the first candle and the low of the third candle is called the fair value gap. Next, you can draw a rectangle on the chart to mark the gap. This concept also applies to the bearish setups. Remember, if there's no gap between the high of the first candle and the low of the third candle, then there is no fair value gap, regardless of how large the second candle is. So now you know how to spot and draw a fair value gap. However, as I mentioned earlier, not all fair value gaps are equal. Some have a much higher chance of giving you a profitable trade. So now, I'm going to share 5 hacks that I use to help you identify which fair value gaps are the most profitable. Number 1. To ensure that a fair value gap has a high chance of success, it needs to remain what's called unmitigated, which means not tested. Whenever you see a fair value gap on a chart, you need to make sure that it hasn't been retested by the price yet, because the effectiveness of a fair value gap decreases once the price touches it for the first time. For example, if you see a fair value gap that forms, but you also notice that the price has already retested it, then it's no longer an effective fair value gap. Another important thing to note is that the price shouldn't retrace too deeply to the point where it closes below the gap. If it does, then the fair value gap is also invalidated. So the best fair value gap entry is when the price hasn't retested it before. And when it does retest for the first time, make sure it doesn't break below the gap. Number 2. Whenever you spot multiple fair value gaps on one setup, such as this example, always prefer the ones with large size. Larger fair value gaps, such as this one, almost always work better compared to smaller ones, because they represent a stronger imbalance between buyers and sellers. This means they are more likely to act as stronger areas of support or resistance. Moving on to number 3. If you found a setup with multiple fair value gaps that are about the same size, and none stand out as significantly larger, you'll need to filter them out based on their position. The ones you use are the fair value gaps located in the lower portion of the move, which usually has a higher chance of working. But to do this more precisely, you'll need a tool. On a charting platform like TradingView, you can use the Gambox tool. You then go to Settings and set the price levels to 0, 0.5, and 1. To use the tool, you drag it from the swing low to the swing high of the movement that contains multiple fair value gaps. This line in the middle separates the fair value gaps, and you should only focus on the gaps located on the bottom area and ignore the ones on the upper area. Same thing for shorts. Drag the tool from the swing high to the swing low, and only focus on the gaps located on the top area. If you're looking for a reliable crypto platform to trade and invest in crypto coins, consider registering with one of the largest cryptocurrency exchange platforms, Bybit. Once you've created your account, navigate to the market overview on the homepage. Here, you can access the list of cryptocurrencies available on Bybit. If you click on Trade, a page opens that allows you to access the price chart and trading tools to analyze the current technical situation of the market. You can also place buy and sell orders directly from this page and search for any cryptocurrency you want from the top left corner. So if you'd like to receive a $30 bonus on your initial $100 deposit, simply sign up to Bybit through the link in the description. Number 4. A type of setup you should absolutely avoid is when a fair value gap forms as the price approaches a major key level. For example, let's say you spot a bullish fair value gap forming. But when you look back, you notice that there's a major resistance level above. so it's best to ignore this fair value gap. This is because key levels could cause the price to be rejected and reverse from them, which may invalidate our initial fair value gap. Moving on to number 5, fair value gaps that form after a break of structure are gold. If you manage to spot these types of fair value gap, they have one of the highest win rates compared to other setups. When a fair value gap forms near and after a break of structure, like this one, it signals a high win rate setup. In such cases, the price has a higher likelihood of retracing to this gap and bouncing from it. So now that you've learned the 5 hacks to spot high-quality fair value gaps, let me share the best entry technique for trading them once you've identified one. The best entry point when trading a fair value gap is to enter a trade right in the middle of the gap. To do that, we use the same Gan-Fan tool from earlier, drag it from the low of the fair value gap to the high of the fair value gap. And so, this middle point will be our entry. Next, you wait for the price to retrace to the midpoint. Once it does, you're good to enter the trade, so you open a buy position. And as for your stop loss, set it at the break of the fair value gap or the point of invalidation. Now, I want to share the 3 advanced strategies using the fair value gaps that I use to get consistent profits. Now let's move on to advanced strategy number 1. The first strategy is called inversion gap, which is a type of fair value gap that has been previously broken. Now, just because a fair value gap has been broken once, doesn't mean it's no longer useful. In fact, you can utilize it one more time as an inversion gap, as there's a possibility that price could reject the level once more on its next move. Here's how you can apply this strategy. The first step is to look for a fair value gap that has been broken. This means the price has already moved through it once. In this case, we see this bullish fair value gap that's been broken. Next, wait for a retracement back towards that gap. This broken fair value gap now acts as a resistance level. Once it retraces, take a position opposite to the original direction of the fair value gap. If it was a bullish fair value gap, open a short position. Now, manage your risk by placing your stop loss just above the fair value gap and aim for a take profit level at twice the distance of your stop loss. As the price reverses and hits your profit target, you secured a nice profit. Important note to remember, inversion gaps typically only work once, so if the price crosses the fair value gap multiple times, the setup loses its validity. Advanced strategy number 2. In this strategy, we're using fair value gaps in combination with the Fibonacci retracement tool. If you don't already know, Fibonacci retracement is a popular tool that uses horizontal lines to show areas of potential support or resistance. In this strategy, the 61.8% level on the Fibonacci tool, also known as the golden zone, is particularly important. So, to combine fair value gaps with the Fibonacci retracement, we're using confluence between them. First, you'll want to identify all the fair value gaps that exist on a setup. Once you've marked these gaps, use the Fibonacci retracement tool. Apply it from the low to the high of the movement that has multiple fair value gaps. Next, focus on the fair value gap that's closest to the 61.8% Fibonacci level. So this is the gap that we're interested in. Next, just wait for the price to retrace that gap. Once it does, make sure the candle still closes within or above it, such as in this example. Once our entry criteria are met, you can enter a buy position. Then, place a stop loss below the fair value gap and set your take profit target at 2 times stop loss. As you can see, price bounced off the fair value gap, giving us a good profit. Advanced strategy number 3. In this strategy, we're combining fair value gap trading with multi-time frame confirmation. First, start by choosing a time frame, preferably higher time frames like the 4-hour chart. Next, identify the long-term trend using the 200-period EMA indicator. The EMA helps to ensure that we're trading in the same direction of the long-term trend. If the price is above the EMA, you only look for bullish fair value gaps. If the price is below, you only look for bearish fair value gaps. In this example, the trend is bearish, so we'll look for bearish fair value gaps. We find one right here, a large red candle with a gap between 2 smaller candles. Since the price hasn't retested it yet, it's still unmitigated, making it a potential setup. Next, we wait for the price to retrace to the fair value gap. Once it does, we prepare for entry. Now, relying solely on the midline of the fair value gap for entry can sometimes be insufficient, as price may reverse from the gap before reaching it. So, we use another confirmation method, multi-time frame analysis. We zoom into a smaller time frame, like the 1-hour chart. Here we use a momentum indicator like the MACD to help for confirmation. so we wait for it to cross downwards. Once it does, we can take a short position. Next, place your stop loss at the invalidation point of the fair value gap and set your take profit at twice the size of your stop loss. As you can see, this trade ends up being profitable. Now here's a quick guide on which timeframes to choose for multi-timeframe confirmation. So as you can see, trading the fair value gaps can be very profitable, and that's how you can use fair value gaps to gain an edge in trading. However, understanding the fair value gap is just one piece of the puzzle. To truly master the full smart money concepts trading, you also need to understand order blocks. That's why you should check out this video, where I explain in detail how to combine fair value gaps with order blocks to find high profit trade entries.